Well, good morning, Bob.
Good morning, Bill.
We have a lot of things to talk about today. First, the appraisal report rollout, and all our reports rollout are continuing, and that's all smoothed out. It's all good. And this morning, we're talking about really volume. And is it too low because of underwriting requirements?
Well, it certainly is too low.
Well, I guess it depends on your perspective, right? So if we take a step back and we talk about home buyer affordability, can people afford to pay for their homes? And we see where they've paid down their debt, so their balance sheets are, their personal balance sheets are getting better.
Affordability is pretty good. I mean, the interest rate's low, employment's improving. So I mean, people are able to pay their debts, and
they would like more debt. They would like to buy a new house.
Well, evidently not. Applications were really low last week.
So let's talk about that. Let's talk about is the chicken and the egg problem, and with applications. So are people being discouraged from applying because they hear that it's just too hard to get a mortgage right now? And because look, it used to be very easy to get a mortgage. You know, you'd have a barbecue in the backyard. Your friends come over and they would talk about how easy their lender was to work with. They gave them all this money, and they've got this big house.
Yeah, not great.
It's great. The problem is you have to pay for it, right? You have to pay for it.
Well, you know, a lot of people got hurt.
And everything goes in cycles, right?
Right. And now lenders are pretty cautious. There was an article in the New York Times this weekend talking about we need to bring jumbo back. And
jumbo, for our listeners out there that may be
I don't mean jumbo, I meant subprime.
Subprime.
Yeah.
So for our listeners out there, I was going to explain subprime anyway. I was just going to call it jumbo subprime, which we have that too.
No. I was talking about subprime.
That's okay. So basically, subprime is like all the folks in Mississippi. All right, I'm a native Mississippian, so I can say that.
I mean, you know, the
I don't mean
idea
that literally, but basically, if it's less than about 680, you're talking about subprime.
Well, that's true. But at the same time, there are also situations where people's income is from being self-employed. It's not so easy to document that income.
That's just like it's not qualified for sale to the agencies. It's not a GSE deal, so it's less than subprime. Less than prime. So if it's almost GSE qualified, we call it Alt-A. Remember all the Alt-A stuff?
And Alt-A and
let's talk about B. Let's talk about B and C. Okay, let's talk about B. And so, when I was in physics, B's a good grade.
Well, not my physics.
yeah. I've got a son who is a physics major, and his professor told him C was a good grade in physics.
I was always real happy to get a C.
So let's talk about the B grade credits, all right? Not the A grades, the B grades.
Well, I mean, you know,
are we doing any of those? Are we doing any B grades right now?
Not. There are some. There was in that article.
You gotta look hard, though. You gotta look hard.
They talked about some of the mortgage lenders are starting to open up subprime a little bit, and but now the due diligence they do on those is a whole lot more than they used to.
Yeah, you know? the perception is it's a hassle to get a mortgage.
You know, there's a good strong argument for having a subprime market. The reason being is that there are people who are moving up, they've got a good job, they don't have a strong credit history necessarily. But now they've been paying their rent and they're trying to be good citizens.
The vast majority of subprime borrowers paid.
All the way through.
All the way through. The vast majority paid. And we had a pricing problem though. We didn't price it like it was subprime.
Exactly.
And we didn't price that paper factoring in the default and the loss given default. We didn't price that in.
Well, certainly not with the kind of defaults that we had, right?
Nor the magnitude. We had a bigger number of defaults, a higher percentage, and then we had a much greater loss severity.
Right. The market went down much further than anybody anticipated.
Exactly, and that was not priced in. None of that stuff was priced in.
But you know, a lot of investors are really anxious to get some of these higher yield loans.
Yes, they are.
The yields, interest rates are so low across all types of investment right now that they're very eager to get some of those kinds of loans.
In fact, I was meeting with a big investor the other day, and they said to me these words, probably a little bit in jest, but not really. They said, I want a 540 FICO with a a 7 to 8% yield handle. All right, and so that's like I can relate, right? It's like down to the credit spectrum. All right, so for our listeners out there that may be in a different aspect of the market, typically you need to be 680 plus, but really in the last 3 or 4 years you had to be 720 plus.
Oh, exactly.
In some cases, lenders are looking at 740 in terms of a FICO score, and the idea is to originate a loan that will never default.
Exactly. I mean, basically they're going for 0 defaults.
Right.
And, I mean, what is a reasonable amount of default? I'm talking about a paper tomorrow in D.C., and I was looking at, what they're doing is looking at the D.C. Baltimore metro area over some period of time and looking at the impact of various components on the housing prices.
So you just sprinkled in with the other speakers, or because you're speaking, I believe, to a very conservative think tank, and maybe they just need your token liberal. Is that you?
Well, maybe they want to hear the truth occasionally.
Maybe so. I think they just sprinkled in their token liberal. Okay, it's all good.
Anyway, I was looking at, I was trying to segment the market a little bit to try and get some idea of what's going on in foreclosure over this time frame that they're looking at. And I was having to break the foreclosure rates in these different zip codes into 3 groups. Less than 20%, greater than 20 to 40, and greater than 40% of all sales were foreclosure sales over this time frame.
So basically the market has tanked. If you've just got foreclosure sales going, the arm's length market is being driven by the foreclosure market in some of those areas.
Yeah, it's really interesting. We do a distress estimate. When we provide a lot of our analytic products, we provide an arm's length estimate of value and then a distressed estimate. And what's interesting is if there are just a few distressed properties in a neighborhood, there's a big spread between the arm's length and the distressed.
So there's not that much impact. In other words, the distressed don't have that much impact on the arm's length.
They don't, and there's a tremendous penalty associated with buying a distressed property.
So those are the neighborhoods, if you were going to be an investor, you'd probably want to buy in.
Exactly.
Because you get the biggest bang for the buck when it comes back. You cure it.
But in a neighborhood where there's a lot of distressed properties, there's almost no difference between the arm's length sale and the distressed. Because
so the distressed market pulls it down.
Pulls it all down.
Right.
Interesting way that impacts it. But getting back to subprime lending, there's a lot of pent-up demand for people who lost their homes but want to get back into a home. They've tried to pay since then. They've tried to be good citizens, but they would really like to own a home again. And but they're just going to be shut out of the market for right now.
So people want money. They would love to have money to buy a house.
Well, I think they do. I think they would.
And a lot of the credit problems have to do with medical bills.
Medical bills?
Like half of the credit problems, I'm told, just anecdotally, are due to medical bills.
Yeah, I mean, medical bills, divorce, other family problems like that, those are the main reasons that people have.
Not so much paying on their house.
Not so much, although there's a lot of talk right now about this big wave of home equity lending that is now going to be maturing. They've been paying interest only, and now they've got to start paying down the equity.
We have to pay it back?
Evidently, that's what somebody said.
That's not the American way. You just refinance. You got to refinance the debt.
But things have changed.
Well, and the thing of it is, if your credit rating is down, you may not be able to refinance it.
You may not be able to refinance it, and these terms are going to be a lot more stringent now than they were before.
So the property's got to be able to exactly. The property has to be able to withstand that as well.
Right.
And some of those markets, it will, and some they won't.
Right, and if the value of property has gone down, you may not have any equity to refinance it with. So yeah, it's.
So what's a lender to do? There was a report that article you talked about in the New York Times that quoted someone from the Urban Land Institute, I believe Lori Goodman, and basically her report said that we would have made another 100,000 loans a month or 1.2 million loans a year if we just loosened the standards a little bit. That's amazing.
And if we loosened them a lot, then we could.
Exactly. That's what we did last time. Well, we're out of time, folks. we're talking about being fast and loose because we're getting Bob ready to go speak to conservative think tank. You all have a fantastic day. This is FNC Morning View. I'm Bill Rayburn, Bob Dorsey. Bye, Bob.
Goodbye.